Welcome to The Explainer. So today, we're taking a financial concept that honestly usually sounds like intimidating Wall Street jargon, and we're going to break it down into something you can actually use. We're talking about the beginner's basket. It's this absolutely powerful financial tool that makes investing incredibly accessible, highly structured, and frankly, just a whole lot less stressful. Okay, let's dive into this because when most of us think about investing in the stock market, we instantly picture, a wall of chaotic numbers, flashing red and green screens, and just the sheer anxiety of trying to pick that one perfect winning stock. It feels incredibly complex, right? And acknowledging that feeling is super important. It can totally be overwhelming if you're out there trying to pick individual companies one by one, crossing your fingers you make the right choice while somehow dodging all the losers. But what if there was a modern, really elegant solution to just bypass that whole headache?
Which brings us to Section 1. What is an ETF?
Let's start with the absolute basics here. ETF literally stands for Exchange Traded Fund. Now, don't let the word fund intimidate you. The most absolutely crucial part of this definition is that it's exchange traded. This simply means it's an investment fund that you can buy and sell on a regular stock exchange, exactly like you'd buy or sell regular shares of a single company. You don't need to jump through any weird hoops or open up confusing new account types. Honestly, if you have a brokerage account and you can buy a regular stock, you can buy an ETF. It's really that easy. And this brings us to a really fascinating aspect of the ETF. One investment equals multiple assets. So when you put your money into an ETF just once, you aren't just betting on one single horse to win the race. You are simultaneously investing in an entire basket of stocks or bonds or other assets all at the exact same time. You literally make a single transaction, but instantly your money is spread out across a wide array of investments. It's like a giant combo meal for your portfolio. Let's look at Section 2, Nifty 50. A simple example. Imagine your financial goal is to invest in the top 50 companies in the market. Just think for a second about the massive headache that would involve if you tried to do it the old-fashioned way. You'd have to individually research 50 different companies. You'd have to execute 50 separate buy orders. You'd be paying fees on 50 different transactions. And then, you'd have to try and monitor 50 different stocks every single day. I mean, it's completely exhausting just thinking about it, right? But the solution becomes perfectly clear right here. Instead of doing all of that crazy manual work, you simply buy one Nifty 50 ETF unit. Yep, that's it, one single unit. By doing that, your money is automatically and proportionally invested across all 50 of those top companies. The ETF acts as this neat little wrapper that holds all 50 stocks. So buying a piece of the ETF elegantly solves the problem by ensuring you own a tiny fraction of every single one of those top 50 companies instantly. Aha, problem solved. Moving on to Section 3, 4 major benefits of ETFs. Now, what's really interesting about this slide is how these 4 advantages act as absolute game changers, especially if you're a beginner. First up, diversification. Because you hold a basket of assets, your overall risk is significantly lowered. If one company in your ETF has a terrible day, the others might have a great day and just balance it out. Second, low cost. ETFs are highly efficient, meaning they're often much cheaper to own than traditional mutual funds. Third is trading flexibility. Remember how we said they trade exactly like stocks? Well, that means you can buy or sell them at literally any point during regular market hours. You aren't locked in, you have total control over the whole shebang. And fourth, transparency. You can literally look right under the hood. The portfolio is completely visible, so you always know exactly which companies your money is invested in at any given moment. No secrets. All right, Section 4, the face-off, ETF versus mutual fund. Let's compare the two side by side. First up, the venue. Like, where do you actually get them? Well, as we know, an ETF trades openly right on an exchange. A mutual fund, however, is typically bought directly from an asset management company, or AMC. Next is pricing. And guys, this is a massive difference. An ETF gives you a real-time price. As the market moves up and down throughout the day, the ETF's price changes minute by minute, so you know exactly what you're paying right then and there. A mutual fund, it only gives you an end-of-day net asset value, or NAV. You don't actually know the exact price you bought or sold at until the market officially closes for the day. And finally, cost. Because ETFs usually operate passively, they boast of usually lower expense ratio. Mutual funds tend to have a slightly higher expense ratio because of their AMC structure, which, let's be honest, can really eat into your returns over time. Now, for Section 5, popular ETFs in India. Here are a few well-known examples you're going to hear about a lot. First is Nifty Bees, which is a highly popular ETF that tracks that Nifty 50 we talked about earlier. Then there's Bank B's, which allows you to invest across a whole basket of top banking stocks with literally just one click. And then we have gold ETFs. Now, this is a brilliant way to invest in gold. Think about it. Instead of buying the physical metal, worrying about storing it securely in a locker somewhere, or paying those annoying making charges for jewelry, you simply buy units of a gold ETF. It tracks the price of gold perfectly, giving you all the investment value with absolutely zero storage hassle. Win-win, right? Bringing us to Section 6, a tip for beginners. Look, if you're a beginner looking to dip your toes into the market without drowning in complexity, starting simple is absolutely the best approach. And widely across the board, starting with a Nifty 50 ETF is considered an incredibly simple and highly popular option. You get that instant diversification across the top 50 companies, you get the much lower costs, and you get the ultimate flexibility to trade it whenever the market is open. It truly is the ultimate beginner's basket. Which brings us to our final thought for this explainer. If the Nifty 50 ETF really is the simplest, most transparent, and cost-effective way to start building your wealth and taking control of your financial future, what is stopping you? The tools are right there, they trade just like a regular stock, and honestly, the barrier to entry has never been lower. Thanks for joining me on this explainer today, and I really hope this knowledge empowers you to confidently take that next step.